Unlock the high returns of the expanding venture capital world right here on the Emerging Managers Podcast.
God, I love talking with Ed Lafferty, and we had that panel discussion that we did with him. So he really intrigued me. Saturn Partners, which is an early stage venture capital firm focused on green tech, FinTech, and medical tech. He was talking a bit about MedTech when we were at the panel.
Yeah, and he really delved into it in the interview too. And he has some really great insights on, the industry and where it's going and how AI and other things play into it.
Yeah, he's got a great background with private equity. He consulted for banks. So he's got a kind of a broader, I'm going to call it institutional capital model, as well as the venture capital.
Right. He got really good training from a practical standpoint, maybe not so much an academic standpoint, where he was with, Berkshire and another other high-end, companies. And he got to learn everything from analysis to due diligence and finance. And so he brings a really good background from his past that he's applying today.
Well, and I think that, this is what we're going to hear about in the interview, that really makes it so that they have a flow through into all the next round and the next round and the next round, because they've got this co-investment model that they work through.
Yeah, and I think that was really good because the reality is getting that first check is great, but you need to know there is a pathway to future funding. And the fact that he has this network of investors and he has this broker-dealer, which provides him the opportunity to not only get people to invest in his companies through the fund, but then invest directly in subsequent ones.
Well, let's hear about Saturn Partners and Ed Lafferty.
Well, welcome, everybody. My name is Scott Kelly. I am the founder and CEO of Black Dog Venture Partners and your host for the Emerging Managers Podcast. And I'm really excited to welcome a new friend and a fellow Floridian, Ed. Ed, welcome to the show.
Hey, Scott. Good to see you. Good to be with you.
Thanks. So, Ed, before we get into the fund and what you're doing, let's tell all our listeners a little about your background. How'd you get into this? What'd you do before this?
Sure. When I came out of college, I worked for a small consulting firm, and we did consulting work primarily for banks. So we would go into banks and teach them how to sell. The fellow that owned the business he shared his apartment. His apartment was in the top floor of a building that was owned by one of Berkshire Partners' partners. So I happened to network through my former boss to meet my next boss, who was a partner of Berkshire Partners. And I ended up hitting it off with him, landed a job with Berkshire Partners and stayed there for 4 years working. And that's a private equity shop that deals mostly in later stage mid-market companies. So I learned how to do a lot of financial analysis, tax analysis. I mean, there's a lot of financial blocking and tackling. And what I found out there was, I love the work, but I didn't get to do what I really wanted to do, which is something that, working with entrepreneurs. I love to be part of that startup community. Working with these guys, they're all innovators and they make a lot of money and they do some great things, but it wasn't exactly the innovative fabric that I was looking to work with. So I met my current partner, Jeff McCormick, who is the founder of Saturn Partners. He had a broker dealer. And he would raise capital and one-off deals for companies. And I said, hey, Jeff, why don't we roll this up into a fund? Let's, and raising money is hard work. Let's do it once instead of doing it, 20 times a year. And he said, this is probably the right time to do it. This was in the early 2000s. And he said, the market's got some uncertainty. Let's go out and grab try to raise as much as we can. This was just pre-bubble. We closed our fund early because the bubble burst. So instead of continuing to raise, we said, let's just cut it. So we started a $25 million early stage fund, and that was in 2002. So that was our first fund together.
That's awesome. I'm really glad you mentioned the word sales. I'm going to touch on that in a couple of minutes because obviously, in my opinion, I think that's a lost art, especially in this generation of entrepreneurs. So obviously you launched your first fund. So let's talk about, your thesis. Let's talk about how you invest, what you invest, and maybe some other traits of some of the investments you make.
Our investment thesis has definitely morphed over the course of time. When we started our first fund, we were generalists. And I think that's what a lot of venture capital firms back in those days were. They were generalists that were just investing opportunistically. But as we started to invest together, we realized that we liked doing certain deals and we were better at doing certain deals. So through our second fund, we realized that, we're going to stick to kind of what we do best. And what we do best is we're in early stage, so very early stage, seed and Series A rounds.
Mhm.
And we're also in three different industries. We're in kind of green tech, we're in FinTech, and we're in medical tech, so health tech. Those are the three things that because it's one of those things that you're not only making a return, but you're also doing good. So all those industries, somehow or another relate to improving the human condition, I guess is what we would
Mhm.
call it. So that's kind of what we do now. And our thesis has developed now into those three industries, but early stage. And what we do is our funds invest through the Series B round. Then after the B round, we provide our our investors an opportunity to co-invest with us alongside into later rounds. So
Mhm.
it's kind of, we create that back up the truck moment with one or two companies that are in our fund. So,
Right.
a lot of our investors really like that. That's when we pitch them initially on the fund, they want to co-invest in these later deals. And they like that we shake out the risk in the early stages.
Yep. So, obviously, tell me a little bit about Thesis and Stage. Talk to me about the founders. What are some of the attributes of the founders that you invest in?
Well, the founders that we invest in, like I said earlier, we like entrepreneurial guys that are out there doing it. The guys that maybe on their second startup, those are our ideal guys because I think there's first time founders are great, but they need a lot more guidance. And I think that once founders have got their feet wet and understand what they're trying to accomplish, I think they're better once they're seasoned. So we look for founders that are second time founders or third time or serial entrepreneur types. And we like ones that are in an industry that they know. Maybe they came from industry and they're in the industry rather than people that are kind of retreads trying to shift because we don't really like people to learn on our dime. I mean, education could be very expensive if they're learning on your dime. So that's kind of what we look for.
And now I'm going to touch back to this. You mentioned sales. Obviously, you work in health tech, fintech, and where you're dealing with entrepreneurs that may have good technical skills, may have good engineering skills. You touched on sales, and I believe nothing happens until you sell something. So,
Right.
how do you perceive the entrepreneurs in terms of their go to market and actually selling what they develop? How does that play into your thoughts?
That's a great point because we see the CEOs, and I should have brought this up earlier. The CEO is the chief salesperson. They have to be able to sell their product. They can't sell their product if they can develop it but not tell somebody how it works. They're not CEO material. I think the CEO has to be the chief salesperson in the whole organization. They've got to be able to sell better than their chief salesperson.
Right.
That's my opinion. And we help them articulate it. A lot of times people don't know their pitch. They think their pitch is one thing, and we have to really work on them to give them that, this is what your customers need to hear, not how, this got developed in wherever, it's
Right.
interesting how folks that are engineering types focus on certain things and they need to really understand their customers to be able to sell it.
Right. And obviously, it's very interesting, from a going after investor standpoint. If that's your customer, the thing you want to present to them is not how great the product is, but how much money you can make with it.
Exactly.
And so I'm glad we touched on that. So you've obviously been doing this for a while. You've got a good focus in early stage. You might share some success stories, some things that worked out really well.
Yeah, I mean, we were an early stage investor in Constant Contact. That was one of our early
Awesome.
investments. Back before the bubble hit, it was Free Markets was one of our bigger ones, and that was some people may remember it, some may not, but it was kind of the B2B version of Amazon. So we launched that a while ago. Now we're working on a couple of big projects that we're thinking are going to be maybe even bigger. We've been working with this company called Knop Biosciences, which is an early stage drug development company,
Mhm.
and we've been with these guys since 2002. And they failed phase 3 in ALS, which was very unfortunate. That was in
Mhm.
2011. But we discovered that the drug worked in something else. It works in asthma. That was just by
Oh,
looking at the data. So we pivoted the company, had to raise new capital for it. A lot of our investors stuck with it. We got some new
mhm.
investors in it. And now what we did was we've actually split the company into two companies. We sold the license to Biohaven, which is licensing one of the drugs we had in development. It's called KV7. And what that is it's actually can be used in a couple things. Their main focus is epilepsy. But there's a
Okay.
couple of other projects that they're using. And we've got another spinoff, which is a later stage, phase 3 drug, which is for asthma. So that's called Aratea Therapeutics. So we're working on both of those simultaneously. I'm hoping for something to happen later this year, depending on what the public markets look like.
Yeah, I was just going to bring that up because obviously, there's a lot of things happening over the course of the last several months and several years. And, health tech is a long grind to begin with.
Right.
And some potential things that are happening or things that have happened recently could have a significant impact. Where are you seeing the marketplace, investing in that vertical? Obviously, getting into the deal is the easy part, getting out is the hard part. So,
Oh,
kind of share some perspective on that.
well, the funny thing about drug development is you've actually got to, I mean, it's measured every time you have a phase 1, phase 2, phase 3 trial. And
Right.
every phase costs a certain amount of money. So you kind of know what you're going to spend, which is
Right.
an amazing amount of money, which hopefully AI brings that cost down. We
Yep.
could talk about that later. But you kind of know when you're being measured, and each measurement time is a time to exit. But you always make a decision. Do I stick with the company and go for the big play, or do I get out now? So you
Yep.
can always hit the, get out early button, right? And try to get out after phase 1, but you're not going to really get that big multiple that you're going to get. So we've continuously held on here, for better or for worse. We'll find out. Um, but that's part of the risk you take. That's what we get paid for. We get
Yep.
paid. We get paid to be a home run hitter. I'm not getting paid to, hit singles and steal bases.
Exactly. I really appreciate that analogy. That's definitely the analogy. You mentioned AI, so I'm going to jump on that right now. So obviously, AI has been around forever, but now it's the flavor of the month. But
Right.
let's talk about specifically where you see AI impacting, healthcare, medicine, and things of that nature.
Yeah, I mean, where we see it specifically in the companies that we work on, I mean, we see it in FinTech and environmental tech. It can create a lot of efficiencies, and it's been in there for a while. As you mentioned, it's been under a different guise before. Now it's got a new name, thinking machines, learning machines. It's been all these things, but we're seeing it specifically in MedTech, in the kind of in the drug development, because the earlier stages where you have these animal studies are being replaced. You can replace a lot of animal studies for, there's a whole lot of reasons to replace them. Not only the cost, but also you think about the environmental effect of it. You think of all the effect on these poor puppies and,
Right.
that they're testing this stuff, goats, whatever. It depends on what they're
Sure.
testing them for, but
Sure.
it's not very humane, really.
Hmm.
So this really, and it also improves the time to market. I mean, you can really
Hmm.
run these tests much quicker and much more efficiently. So we're really hoping to see that kind of get, instituted into the drug development. And I think we can get some outcomes a lot faster and get drugs that are really needed out to people quicker.
I think it's going to be transformational, and I'm looking forward to seeing the developments there. So let's pivot a little bit. So obviously you've raised some money. You have several LPs. Let's talk to LPs now. Let's talk about
Yeah.
potential LPs and others. So first of all, why don't you give us kind of a snapshot of who your current LPs are?
Sure.
Who are these people? What's their backgrounds?
Yeah, we've got, and this also, we can play this into deal flow too, because it plays into it well. We've got, our base is primarily high net worth individuals who have made their money as entrepreneurs.
Mhm.
And many of them have actually invested with us or we have backed before. So, about 70% of our LPs are repeat LPs. Some of them have been entrepreneurs that we've backed. Some of them have been kind of attorneys that work for entrepreneurs, but we've got a great entrepreneur circle. And that's part of our deal flow.
Right.
These guys are out there. They're creating companies. They're meeting people. They're meeting other entrepreneurs. They see a business plan. They call me and they say, Ed, I got this great plan. You got to take a look at this. You got to meet, Scott. Scott's got this great idea. So this
Right.
is where most of our deal flow comes from. And, people call this proprietary deal flow. It really is, because they give it to we're kind of the first right of first refusal on the deal flow, which is great
Mhm.
for these guys. Now, we've also got a couple of pension funds and we've got a few charitable organizations that are investors as well. But the majority, I would say probably 80% of them are high net worth folks, family offices, and multiple family offices. So those are our guys.
It's really interesting it's great to have, LPs and investors in your fund that aren't just dead money. They're obviously
Right.
providing some value to the fund in
Yeah.
terms of deal flow. Yeah, do these LPs, are they in these industries? Do they provide other insight, as you're doing due diligence or post investment?
Many of them help us with diligence. Many of them have been in the industry, and that's why they can look at a deal and say, you got to look at this. This is the next, the next best thing since sliced bread. Because I've seen this fail before. These guys got the special sauce, or they've got the right person, or whatever it might be. So that's one thing they do. A lot of times they also help us raise money, because a lot of these guys are connected to other organizations that have capital. So they'll call us and they'll say, hey, you got to talk to this guy. He likes this kind of investment. I think this is right for him. So they'll call me and they'll stick me on him. We'll try to sign him up as an investor. And sometimes, sometimes they don't want to come in a fund. Sometimes they'll say, listen, I'm not a fund guy. I'm not a fund investor. What I want to do is co-invest. So we create syndicates to invest alongside us with some investors as well. We've got a broker dealer that we still use, so we can set that up to have co-investment.
Yeah, I want to touch on that. I'm glad you brought that up. So talk to me more about how the broker dealer plays into what you're doing, because obviously not a lot of venture capital funds have a broker dealer affiliated with it. So talk to us and talk to everybody out on the show today. How does that play into what you're doing?
Yeah, it's an interesting. It's almost, sometimes it could be conflicting, right? Because you're trying to raise capital for a company and you're trying to raise money through a fund. So there is a conflict that we have to be very conscious of. But we try to use it to our advantage, because a lot of funds don't have it. So when we go to a company and we talk to a company, we give the company the why us speech. And what we can say to them is, listen, we not only can invest and write a check in the company, but we can also expose you to a whole group of investors who may not want to invest in a fund, but may be interested in participating as investors in this deal particularly. So we can go ahead and do that. So we don't take a fee on our fund, but we do take a fee on all that other. So there's kind of we try to keep the fee separate. We credit our investors for anything that goes through the fund that we take a fee for. We credit the investors back. So there's this whole, inside accounting that we had to set up.
Sure.
But we're trying to be fair about it, but we're also trying to for advantage. And we also use that broker deal at later stages. So for example, this Aratea deal that we are invested in, we set up we're investing alongside Bain Capital, Google Ventures. I mean, this is a syndicate of later stage investors. We call our investors and said, listen, do you guys want to get in this? They all said yes. We set up an SPV. We used our broker dealer to set up the SPV, and we invested in this later stage deal. So it's kind of how we follow along with our portfolio companies as they get older.
Yeah, it really adds another value add opportunity for companies to raise more capital. And like you said, it provides a real alternative for companies that present to you. There's, as you said, there's more ways to skin the cat, and helping some of these entrepreneurs and finding opportunities for investors. So you touched on this now. You took a little bit of thunder away. So I'm going to ask the question I always ask everybody. In the field of 3,200 venture capital funds, 1,800 fund ones, why your fund and why now?
We are, I'm going to go back to my baseball analogy. We are like Sammy Sosa. We are swinging for the fences with every investment that we make. We are not trying to hit singles. We're not hitting doubles. We may strike out a lot. We're going to have a higher strikeout record because we're trying to make, and I think we talked about this before, Scott. We're trying to make alpha. Alpha is our job. And alpha is the difference between the market returns. We want to provide a better return. And we may not do it through our fund, but we may do it in later stages, because we'll give investors the opportunity to invest later in a deal. They can back up the truck. They can invest, a small amount in the fund, but then invest a large amount in that one winner that comes out of the fund. And then the return to them is much greater than they would have gotten in the fund. So that's one of the big benefits we really present to our investors.
And that's, I'm glad you brought up alpha, because that's really what we found in our research, before launching the podcast, is that the alpha on these earlier stage funds, fund ones, fund twos, fund threes, is far better than the monoliths in the industry. And I think for investors that want to diversify or add, venture into their portfolio, look at the opportunities to get better returns. And also for those that are advising, folks, you're finding, the people that we're going to be, we're talking to today are also going to be RIAs and advisors that are managing portfolios of these high net worth people, and they want to do better than the S&P. And you can't do that by buying the S&P. And so, I'm really glad that you're swinging for the fences, because for that portion of the portfolio, you need to bring up the return of the entire portfolio.
We don't manage. I mean, we're not portfolio managers. Like some guys, they try to manage a balanced portfolio. That's not what we do. I don't have a bond portfolio to match off, offset the risks that I'm taking on the other end. This is all risk. This is all high. We diversify among industries, We may
Sure.
diversify among stage, but we don't diversify by buying, bonds or mezzanine finance or any of that stuff.
Right.
We're out there. We're swinging hard.
E- Exactly. So, any final thoughts or things you want to share with the audience today?
Yeah, it's one of those things that we've always talked about when, we try to raise capital. It's easy for fund of funds and money managers to pick the big guy. It's easy to pick the big guy. Go out there and pick the name brand because nobody ever got fired for using whatever, right? You hear that so many times, but you know what? You have to, if you really want to create oversized returns, you need to create a place for early stage venture funds, startup venture funds that are really swinging for the fences. This is the way you can make a difference in your portfolio and really create those oversized returns. You may not get those oversized returns in some of those later stage funds because some of those later stage funds, they get into some of these investments like very late. And it's
Yeah.
kind of almost like window dressing, right? It's like,
Yep.
back in the old capital markets day, you used to buy stuff before the end of the quarter, right?
Yep. Exactly. Exactly.
So if you really want to create that return, look at these emerging managers because they really create alpha for your portfolio.
Yeah, you make a really good point there because the reality is you want to be able to invest in the name brand companies before they become name brand companies.
Correct.
Well, Ed, how can people learn more about Saturn and yourself?
Well, we've got a website, of course, SaturnPartnersVC.com. You can go there, follow me on LinkedIn, at Laugh. I'm there too. So those are the two places that it's best to find me. I'm in the Tampa Bay Innovation Center. That's one of the places I've been there for the last couple of years. I've got my office there. We moved out of Boston years ago. One of my partners is in Pittsburgh. The other partner is down in Florida. I'm in Florida, and my other
Mhm.
partner's in Puerto Rico. So we've all, well, two of us have gone for better weather. The other one's staying where he is. So we close our
Well,
Boston office.
yeah, I made the same decision. An ex-New Yorker, and now I'm in the sun with you. But so
Yep.
Ed, thanks for being on the show today. And use that for all you out there. Make sure you like, subscribe, and share this great podcast. And again, Ed, thanks for being on the show.
Great to be here. Thanks for having me, Scott. Take care.
Scott, I don't know about you, but for me, I really thought that this look that they had on the swinging for the fences, the home runs, really, not going as conservative as others do, I was surprised about because they were talking about wanting to go Series B, like, wanting to get all the way through to that model. So I thought they would be more conservative, but he really wasn't focused on that.
Well, I think he really understands where venture capital plays in the total landscape of someone's investing portfolio. He really understands that, in order to beat the S&P, in order to get that, alpha, you got to swing for the fences. And the reality is, I love the fact that he was very honest and pragmatic. He realizes, look, we got to swing for the fences. We're going to have a bunch of strikeouts, but the handful or more of these home runs are going to give us superior returns, over time.
Yeah. I was wishing that I was in his wheelhouse of, the type of investments. I mean, my company's not in that type of investment because I love the two things that he really says, that they're really looking at seasoned entrepreneurs, who've had multiple companies who have that because they require less guidance and are more likely to succeed. I was like,
Yeah.
that's me. Like,
That's, I think he wants to deal with adults in the startup space. And if there's nothing wrong with this, nothing starting out at beginning your journey as an entrepreneur. In fact, obviously, I spend the vast majority of my time working in that area. But the reality is, if he's working to get superior returns, yeah, those returns are going to have a high, you know, um, are impacted quite a bit by the management involved in their experience.
yeah. And the other part he said was the sales emphasis. So, like, I was like, that's my company too. Like, because he loved that idea of having the sales be the CEO, right? That they're being directly responsible for those sales. And that's exactly the way our company is structured, that Tom Hazard is my partner and husband, but he's the CEO and in charge of the sales. And I'm the director of AI in charge of the tech. So like we have this division of labor, but that focus on sales makes us much more focused on the customer and market proof.
Absolutely. And I love when he talked about sales because I think, I'm not sure it's, from a generation standpoint or technology standpoint, sales has become a lost art by human beings. And, the reality is the fact that wants to make sure the same person that's building the widget is selling the widget. That's the perfect way to approach it.
Well, I think you find out so much more about what resonates and what works. And the fact that Saturn comes in and also helps articulate that pitch, focusing on the customer needs, focusing on the message, is going to make it easier to sell later.
Yeah, exactly. And honestly, the best way to, get those home runs is to make sure you get the best pitches.
That's right. So, I mean, investors looking for high risk, high reward opportunities, access to unique deals, additional support beyond just capital, Saturn Partners might just be the right partner for them.
Absolutely.
Yeah, tell me a little bit more about your thoughts on the co-investment opportunities. This idea that after a Series B round, there might be more opportunity for the early investors.
Well, it's interesting. At some point, we're gonna have. You and I will have a conversation. We'll talk about maybe the changes in the industry. Venture capital doesn't have the same cachet it had in the past. It's really becoming like the dinosaur of how to finance companies in a lot of respects. What you are finding is people, private equity is getting in there. Individuals are getting in there using SPVs and other vehicles. And I think that's a trend that's going to continue. I think the reality is this VC model, although it's been a model forever, it's some of the things are and how they do business is antiquated. It doesn't really jive with more sophisticated investors, new opportunities for individual investors to get involved. You can look on, if I got CNBC or Bloomberg on, there's some ETF that's investing in venture capital. So I think there's other ways to go about it, and and honestly, from a venture capital standpoint, getting other people to again, there's a couple angles on this. Obviously, if they get other people to invest in the subsequent round, they're investing at a higher valuation, which improves the DPI of their fund. So they're really kind of being able to ratchet up the balance sheet by getting other people to invest. So
Do you think that broker-dealer is a big advantage?
it's and I'm clear, it can be. It really can be, but he did make sure it was balanced because you had to be careful. You know, the reality is you have to make sure that you're bowing to the right master for
Yeah,
these
that's right.
businesses. So it does provide an advantage, um, but he understands that you've got to kind of keep church and state, separate from that standpoint.
Well, was really so intrigued and so glad to get to hear Ed also talk on the panel. To tell everybody a little bit about the panel that we participated in.
So we got to be involved in Max Pong has this large virtual event that he hosts periodically. And, they reached out to me to put together a panel of emerging managers that really talked about what we're doing on the podcast. So we got a really good opportunity to, in front of this audience, put them in front of 4 emerging managers and really educate them on why to invest in them and what the advantages are. And I thought I thought it was great. And, and those are more things that we're going to do, for these companies these managers, as we do the interviews. This is, the podcast is one piece. Yeah. The idea is that these managers that are being on our podcast will be in opportunities like that, both online and in person. And I think, it was really good to create a good audience, for that. We had, a great room of active people and some really good dialogue. In fact, they even emailed me after the fact and we're so pleased about how it went versus, respectively some of the other, breakout sessions.
Well, yours was so packed, like it kept rotating out. I was watching the number and it would like hit the max in the room and then it would go down a little bit and then it would fill right back up again. So so it was obviously people are dying to get in. So that was a good model. So I think we'll have to be on the bigger stage next time or the bigger room.
For sure. For sure.
I love that. Well, if anyone out there is listening and thinking, hey, I'm an emerging manager and I should be on this show just like Ed Lafferty of Saturn Partners, then you've got to go to emergingmanagerspodcast.com and go fill out the application that's there. Scott will look it over, so will I, and we'll see if you're the right type of emerging manager for us to have a chat with.
Fantastic.
Well, Scott, I can't wait till next week. We've got more. We've got so many in the queue. We've got to get through. We almost should speed up our publication of these, but we're trying to keep them to one a week so we can promote them properly as we go forward. So make sure you follow Scott and I on social media as well. And we'll be back next week with another episode.
Join Scott Kelly, Tracy Hazard, and their high-performing capital fund manager guests next week on the Emerging Managers Podcast. Don't miss our upcoming virtual and live VC Fast Pitch and podcast events. For more details, background on our guests, or an application to be our next guest, visit emergingmanagerspodcast.com. Don't miss out on shaping the future of venture capital and entrepreneurship with us by joining our robust community of innovators and investors today.